In early 2026, the United States and Iran stood at the edge of open conflict. The immediate physical consequence of this standoff was a bottleneck in the Persian Gulf. The Strait of Hormuz, a choke point handling roughly 20% of the world's maritime oil, was effectively blocked. This stall in maritime traffic triggered immediate concern from the International Energy Agency. Executive Director Fatih Birol warned that the resulting shock could surpass the energy crises of 1973, 1979, and 2022 combined. That geopolitical pressure reached consumers almost instantly. As traders braced for supply destruction, global crude prices climbed past $110 a barrel. With the world focused on the possibility of a total energy collapse, the environment was primed for public distraction. During the peak of the crisis, platforms like Reddit and Binance Square became centers of speculation and high-speed financial rumors. One story in particular saturated these forums: the claim that 19-year-old Barron Trump had purchased $30 million in oil futures just 2 days before the conflict reached its breaking point. Online communities interpreted the rumor as a clear indicator of insider knowledge, a signal that the war was certain to escalate further. Fact-checkers at Snopes investigated the claim and found no supporting evidence. There were no documented financial filings or disclosures to suggest a transaction of that scale actually occurred. The rumor also contradicted the logic of the market. A $30 million long position is a bet that prices will rise. However, the events that followed would have resulted in an immediate, massive loss for that specific trade. The $30 million rumor dominated social media conversations. Meanwhile, a documented movement of $2 billion was quietly taking place in the shadows of the futures market. On March 24th, Donald Trump set a definitive 8 p.m. deadline for Iran to reopen the strait. The rhetoric used in the ultimatum was severe. The public was told that without a deal, a whole civilization will die tonight. Institutional investors responded by moving into defensive positions. The financial consensus was heavily weighted toward the expectation of a military strike and further energy disruption. As the deadline approached, betting on an immediate de-escalation seemed to contradict all available public intelligence. Then, 5 minutes before the 8 p.m. deadline, the data shows a sudden shift. This chart tracks the volume of S&P 500 futures. Against a steady baseline, a massive anomaly appears exactly at the T-5 minute mark, the construction of a $1.5 billion position. At that same second, the oil futures market saw a simultaneous surge. 6,200 large trades worth roughly $580 million hit the tape at the exact same timestamp. Moments later, the announcement broke. The threat of war was averted by productive talks and a 2-week ceasefire. Markets reacted instantly. Oil prices dropped 15% to go below $95 a barrel, while global equities regained trillions of dollars in value in a single window. These trades were positioned in direct opposition to the public narrative. Whoever placed them anticipated a de-escalation that almost no other market participant saw coming, capturing a massive payout in less than 5 minutes. While the White House dismissed claims of insider activity, the timing has led global regulators to raise questions about transparency and market fairness. Analysts note that this fits into a broader pattern of suspiciously timed market bets appearing just before major geopolitical shifts. The Barron Trump rumor relied on the viral, emotional nature of social media. The $2 billion anomaly, by contrast, was an anonymous, highly sophisticated operation that moved through official financial channels. Viral stories can capture the public's attention for weeks, but they often leave no trail. The $2 billion anomaly remains a matter of record, a silent signal in a world of noise.